Super. So this is the second in my series of videos ahead of DealCatalyst's Europe Specialist Lender Finance event. I have with me Dan Pietrzak of KKR. Dan, would you like to introduce yourself briefly?
Yeah, no, happy to, Owen. And again, nice to see you. Dan Pietrzak, I run the private credit business here at KKR. I've been with the firm for 8 years. For the prior 10 years, I was at Deutsche Bank, and before that, a handful of structured finance or leverage finance jobs.
Super, thanks a lot. My first video, I should say, was actually with one of Dan's portfolio companies, Richard Evelyn of Oodle. So we're keeping it KKR for the time being, but we're going to do a few others later on.
We appreciate that.
Great. So let's kick it off kind of high level. And how do you see the balance of risks and opportunities in European asset-based lending at the moment?
Yeah, no, it's a fair question. I mean, I think overall, this, we'll call it sector, has had a lot of tailwinds for probably going all the way back to the financial crisis or the sovereign crisis that existed in Europe. I think it's evolved kind of meaningfully since then. But if you start with kind of the opportunities, I think there's been a growing presence of specialty finance companies in Europe, which has clearly meant a certain amount of deal flow for us. Those fincos would have been maybe replacing some of the lending that banks would have done. So I think that would be sort of one. Two, I think what's gone on sort of the banking sector sort of generally, probably a little bit more noise in the U.S., quite frankly, than in Europe. But there's been a great focus, in the last, call it 6 to 12 months on capital. I think a little bit probably what happened with Credit Suisse on their AT1s is making banks think about, where else, should I think about, my capital optimization. That has definitely meant, we'll call it a more robust pipeline as it relates to risk transfer transactions, right? So I think that's been sort of helpful to see. And then what we have seen in Europe is, larger corporates maybe being a little bit more focused on their own, capital allocation, right? Where they had dollars deployed, was there a better way to do that? There's a handful of pipeline deals as it relates to that now. And, I would say the PayPal transaction we did throughout Europe was an example of that. Them being a bit strategic, where they deployed their dollars, and instead of keeping it on balance sheet, sort of involving, someone like ourselves. So, I think the opportunities have been great, and I think we've been happy to see that. I think we always are mindful about the risks. I think the UK has probably been first and foremost in that. The world was pretty negative on the UK for some time. I think we were a bit more constructive, but there are clearly some risk factors there. I think one of the biggest ones now is the rate resets on all these mortgages, right? And what's that going to mean to the consumer? And then, on the continent, I think we were, clearly worried about, if you went back a year, what kind of a very cold winter might have in terms of energy prices, how that might pass through to the consumer. I think we're always thinking about, some of the demographic, challenges for the Southern European sort of names and what that might sort of mean. But I think, net, the opportunities are probably outweighing the risks right now, just in terms of deal flow. I think we just need to be cautious for how we deploy money.
Sure, absolutely. Kind of drilling down a bit, are there any asset classes, subsectors? You've mentioned the PayPal deal, of course, but anything that particularly appeals?
I think it's probably more the themes than the asset classes, right? I think the themes being, the ones that I, sort of talked about there, how can we sort of partner with banks, whether it's on those risk transfer transactions, or we are still seeing a certain amount of kind of asset sales coming out of those sort of banks. I think we position ourselves as a partner of choice there. And I think that's, paid us some dividends. Those kind of capital allocation points, I think, are sort of interesting now. And I think just the overall theme with, the world's been a pretty volatile place, right? For the past 18 months, I think that's been, macro, it's been, you got a couple of effectively wars going on right now, which is clearly challenging. Capital markets have been sort of bumpy. So I think the theme of this sector, asset-based finance, I think can give sort of real downside protection. I think we've probably pivoted a little bit on the investing thematics, right? In terms of, it might be the same asset classes, but maybe we're further up the capital structure, right? Maybe we're not buying loan portfolios, but we're doing sort of, mezzanine type, ABS sort of debt. So I think it's probably more the themes in the asset classes themselves. But I think those investment themes will continue, for the medium term, not just the near term.
Sure. Picking up on like a couple of the investments we've talked about, obviously PayPal, that's a very strategic forward flow. You mentioned being the strategic partner of choice, and I touched on Oodle, but still that's a home ownership business. Obviously, there's many different ways to get exposure to assets. How do you pick between those formats?
Yeah, and I think what you're referring to here is I think we've been we'll call it nimble in the way that we sort of invest, right? We have the ability to buy asset portfolios that exist today. We have the ability to buy asset portfolios, on a forward flow basis. We have the ability to lend money, right? We can sit behind a bank. We can lend money sort of directly, into a company. We have the ability to invest in some of these platforms to generate kind of that asset flow. I think that's been important for us because, in different markets and different times, certain things might be more attractive than others. But at the core of it, it all relates to, how are the underlying asset portfolios going to perform, right? If they perform well, probably, no matter how you invest is going to work out okay. If they don't, how did you sort of pick and choose, the format of how you were either expressing your view or taking sort of that risk, down. I think in the environment we're in today, it's probably more, either trying to buy asset portfolios that exist today, or going, as I said before, sort of up that capital structure sort of a bit. Because I think while the investing environment is very good, I think you need to be mindful about, this is intended to be a strategy that is really focused on downside protection, right? And getting your money back and taking a little bit of risk on how your return sort of plays out. So I think that's been the biggest kind of mindset, for us as we've been sort of active in the market for the last, 6 to 12 months.
Mm-hmm. Sure. And how do you make sure you're getting adequately compensated for that risk? I guess I'm thinking really here about like relative value between the other things that KKR could be investing in.
Yeah, I mean, this is, in its probably most simplistic form, right? We're trying to do deals that are making, let's call it mid-teens type returns, right? That doesn't mean that every deal we're kind of just solving for that, right? There's certain deals that if we think are extremely strong from a risk-adjusted return basis, maybe you're doing it, a little inside of that. For the things that might be complex, or require a tremendous amount of man hours or human capital, right? Maybe you're trying to make it a little bit sort of wide of that. I go back to the thesis though of looking to ensure our capital is protected from a principal perspective, right? We're almost in every deal thinking about what is that GFC case or what is that sort of severe downside case? Do we feel like we're covered there? That's sort of strong, right, from an investment kind of thesis perspective. And then, where do we see kind of that base case returns coming out, or where do we see certain upside nodes that kind of might exist, right? So, I think that's kind of again, go back to the range of outcomes we're trying to get, but again, really focused on that downside protection or ensuring our principal dollars are protected.
Mm-hmm. Sure. I think you've touched on some elements of this, but kind of how has the rate cycle affected your business?
Yeah, well, the rate move has been meaningful, right, to say the least. I think net it's probably been a negative fact, for most in this kind of sector. I think it's a pretty traditional, sort of common or view that a lot of asset classes, the rates or the yields on the underlying investments have probably not moved as much as the cost of financing, right? And if you think about most of the things we're doing here, right, we are, acquiring or sort of owning asset portfolios. We're using the bank market or the securitization market to finance that, right? So that's put some pressure on, let's call it margins or sort of gross returns. Now, obviously, for certain things, you're able to, alter purchase price, right, or alter other things to get you, back to the returns that you sort of want to get. But I think it's been a little bit of a headwind, right? If you're going to be honest. Now that said, I think because those rates have really moved because of what we've seen in the world, right? Everybody talks about inflation. Everybody's talking about the volatility that exists. The pipeline of opportunity of deals we're seeing is kind of greater, right? So I think that's kind of the offset to get you back to the same spot. But it's clearly on our mind. The only other point that I would add is, when we are financing these portfolios, whether it's in the bank market or with an insurance company or in the capital markets, we are looking to kind of be kind of matched as it comes to rate risk, right? We're not really in the business of owning a bunch of fixed rate assets and then using floating rate financing, to sort of do that, right? We will either go to a fixed rate counterparty or sort of hedge that out. So you can be you can appropriately risk manage that, but it's probably fair to say it's been a bit of a headwind.
Sure. I mean, I guess this goes to some of the same points. You mentioned an increase in deal flow, but it feels like I'm seeing huge amounts of news flow about new fundraisers, new firms getting into the sector. You guys were pretty early, but how do you see competition in this space?
Yeah, I mean, it has been an asset class that's been in focus for a bunch of institutional investors, right? I think the main driver of that has been, I think thematically most people want to increase their allocation to private credit. But I think they want to do that with a certain amount of diversification, right? Not just adding that next direct lending fund or adding that next level of sort of corporate risk, right? These asset based finance funds or sort of transactions are clearly diversifying, right? If you look at the correlations between how these deals either have or how we think they will perform, it will be different, I think, than that regular way, corporate loan or sort of high yield sort of bond market. So I think that's been the big driver. I feel in many ways, this market is probably where direct lending was 5 or 10 years ago, right? So it's still kind of early days. So I think people raising additional pools of capital here is not a bad fact, right? I think it's getting investors more educated on the space, more willing to play, and I think investors honestly want more than one sort of manager to sort of do that. So I think that's probably positive. And then if you do think about the market, I mean, we estimate the market for this space north of $5 trillion kind of globally, right? So there's a lot of white space. There's a lot of ways to invest. So we'll call it that additional competition. I haven't really seen it in kind of our regular way kind of deal flow, right? I think you mentioned we've been early here, right? We've been doing this since 2016. We've been doing it in this approach of being across a bunch of different asset classes, right? Not being focused on one only. And I think that's kind of paid us, dividends. But I think having been there early, we do have the benefit of a fair amount of either proprietary or incumbent or sort of repeat deal flow, which kind of helps offset that. So I'm probably happier to see more people doing it, investors getting further up the sort of curve, than I'm worried about the competition sort of point.
Sure. I wanted to kind of pull the focus back a little bit and ask one of the sort of big questions that sort of troubles securitization people in Europe. And I wanted to ask it to you because you guys finance quite a lot of interesting, more off the run assets, as I understand it. So it must have occurred to you, why isn't Europe's asset-backed market in public format more diverse and esoteric? Why are we still doing Dutch mortgages and German autos all day long? What would it take to make that better?
Yeah, I mean, I think it's a couple of things, right? I think one has been, the market is still probably well behind just the depth of the U.S. market, right, in terms of investor base, right? So I think that's kind of one. I think two, Europe is a little bit more complicated, right? There's different risks, by country. There's different kind of laws by country, right? There's been talk about a European capital markets union for, as long as I can remember, right? I think that does, present a certain amount of challenges, and I think investors are also focused on maybe particular, currencies or sort of, needs as well. So, I still think there's room for it to grow. For me, it's maybe not the growth into the esoteric stuff. It's just about the depth of the market, right? I think the switch probably turns on and off too quickly for when the market's open or the market's kind of closed, right? Other than for the very sort of vanilla stuff. So, I think the onus is on, a lot of us who might be issuers in that market, or the banks who are the main players, to continue to try to, create more depth in that. But that to me is the most important thing than probably the movement into, sort of the quote unquote esoteric areas.
Sure. And in a way, the sort of companion question is like, what's the private market like in terms of bank financing? So how do you see senior leverage, senior financing availability?
Yeah, I think the banks have done a good job in this space for a very long time, right? They've put on, good loans or sort of good risk. This is going back all the way to the days of the financial crisis. I mean, I can only think of very few situations where, banks have taken any kind of sort of hits here. So I think they've done a good job in that. I think there are a bunch of very strong and sophisticated, platforms inside the European market. Whether that's names like my former employer, or some of the very large, European banks, or some of the American banks who do have, platforms out there. I think it's been a good asset class for the banks, because I think they know that, we're not looking to try to transfer a tremendous amount of risk to them, right? We're using this as a financing tool. We usually have a tremendous amount of capital below them, so the incentives are very aligned. And I think the risks that we're asking them to take are probably single A or sort of above, right? When you think about it from a risk perspective. So when you think about the potential, ROE that they might be able to earn on that, I think it's pretty attractive. Again, for, single A or sort of above sort of risk. So I think the depth of it's been good. If anything, I've actually seen the European banks probably doing more in the last handful of years than less. I think you've had some of these very large kind of national champion type banks growing out their team, growing out their footprint. And I think we've been pretty happy to partner with them and do business together.
Sure. Great. Nearly ready to wrap up and let you go, Dan, but one other thing I wanted to touch on was like the shape of the fintech sector, basically. So 2021, great time to be a fintech, lots of capital, lots of VC money around. 2022, not so much. A lot of these platforms, I guess, would be originating assets for yourselves or for your competitors. So kind of how has that dynamic shifted the investing opportunity in your approach?
Well, I think you're right. I mean, there's been definitely, a tale of two cities in terms of, fintechs in vogue and fintechs sort of out of vogue. I think the honest truth is we probably haven't done a tremendous amount with them to start with, right? I think there's a lot of very good sort of platforms out there, being founded or run by a bunch of very smart people. We have struggled at times with just the alignment of interest, right? People just originating assets to sell to us at a premium price is sometimes hard to get your arms around, right? So that hasn't necessarily been the biggest thematic for us, right? I think it is good for the growth of call it the non-bank lending space. But I think we've gotten more comfortable, partnering with or buying assets from, some of the more established, platforms, or maybe some of those have been kind of more associated with the banks that have been out there. I will say thematically, the one thing that has changed in my mind is I think the fintechs, which is probably what you'd imagine, right? No different than maybe any sort of venture name. in kind of more of a bull market or a frothy market, they're very focused on volumes or sort of volume growth, right? I think the tide has turned. I think they've toggled to be more focused on things like net income, right? Things that kind of really matter to allow them to get to their sort of next capital raises. I think that trend's going to continue, right? I do think when people look back at some of the valuations on these names, right, you're going to kind of scratch your head of how did they necessarily make sense, right? I think these platforms can definitely be worth more than what the base case, FinCo would be, right? If they have the ability to generate unique origination kind of in size. But I think just some of the valuation numbers were pretty off the charts. And I think you could probably say that with the broader kind of venture community, right? That's probably toned down again into more rational valuation numbers. How do you make money? How do you get these things to the next side of their lifespan?
Sure. Super. Look, thanks, Dan. That was super interesting. Really appreciate you jumping on today. Thanks very much.
Well, great. Good to see you again. Thanks for having me.
Cool.